Welcome back, investors. Jake here. One of the most frequent topics of discussion amongst finance YouTubers is predicting the next stock market crash. In this video, I'm going to give you my game plan, what I would do, and why I don't really worry about a stock market crash. Given the tremendous run-up that the stock market has recently had, you're going to see more and more scary news articles like this one. A 30-year market vet explains why the Fed's impact on stocks isn't always as straightforward as expected, and warns that a 50% drop could already be underway. If you want to get more clicks on your video or news article, use really scary numbers like 50%. And it's true. It's true that on average, the market sees a 10% correction every other year. Every 2 years, guys, we see a 10% drop. And for a bear market of a drop greater than 20%, we see those on average every 6 or 7 years. But to see a 30% or greater drop, this has only happened a handful of times. Obviously, the 1929 stock market crash, the 87, the 99-2000, the 2008, and most recently, the 2020 COVID crash, which didn't last very long. And because the stock market occasionally goes down, this is enough to scare people away entirely from investing in the market. But look at these returns by decade for the S&P 500 with dividends reinvested. When you look at the worst ones, the 2000s include the dot-com bubble crashing plus the 2008 recession. Over a decade, you only lost 7% of your money. For the 1930s, you only lost 2%. And because there's been 2 decades in the last 120 years, this is enough for people to say, no thank you. I don't want these 435% returns in the 90s, 376% return in the 80s, 467% return in the 1950s. So when you look at the tremendous returns we had in the 2010s, I mean, it wasn't even in the top 4 by decade going back the last 120 years. So in this video, I'm going to share with you my grand strategy, how I plan to get rich in the stock market after there's been a significant crash, and I'm going to accomplish this by trading options. Now, for those of you not too familiar with trading options, you've probably been told this is a terrible idea, you're going to lose all your money, you think I'm an idiot at this point. Trading options is way too risky. However, if you were holding index funds after the index already lost 50%, then ideally you do have some level of risk tolerance. So if you're willing to take it one step further, you can dramatically increase your returns as the market inevitably recovers. Now, before we go any further, I just want to say I'm not trying to convince you to do anything in this video. I'm just sharing with you what I plan to do based on what I know is true about trading options and option formula pricing. So, a quick refresher on trading options. Options is a zero-sum game between buyers and sellers. For every one contract controlling 100 shares of stock, there is a buyer who paid a premium price to purchase that contract, and a seller who's willing to buy 100 shares or sell 100 shares of that stock. Generally, the buyers, in my opinion, assume more risk because if the contract expires out of the money, they lose 100% of the premium they put up. And on my channel, I like recommending selling covered calls and selling cash secured puts. It's a great way to earn premium or additional income on stock you don't mind selling and stock you don't mind buying. But in this video, we're going to talk about a specific strategy for buying calls, and they're called LEAPs. This is kind of a fun word to say. LEAPs stands for Long-Term Equity Anticipation Security. So they get the P from the single word anticipation. I feel like there could be a better name for this. But when you buy a LEAP contract or a LEAPs contract, These are deep in the money call options, and you buy them usually on companies you're bullish on, but in this video, we're going to do an example on the S&P 500 index. And you choose expiration dates that are very far out, usually 1 to 3 years. And when purchasing a LEAPS contract, I personally favor the S&P 500. You could easily do this on the NASDAQ or the QQQ. The long-term average of the S&P is over 10% a year. And the specific ETF that we're going to do this on is State Street's SPY. Why are we doing it on SPY? And it's just because this is the ETF that has the most options traded on it in the world. So the bid-ask spread for getting in and out of contracts is always very small. This is why I favor State Street's SPY. And currently in my brokerage account, guys, I own 200 shares of State Street's SPY worth $86,846. Additionally, I'm saving up enough cash to buy an additional 100 shares. So I'm assuming a lot of risk if the entire market falls 50%. If this worst case scenario for the market were to happen, what would I do? And what I would do is I would start buying LEAPS contracts. So for State Street's SPY to drop 50%, this ETF would have to go to $217 a share. Now, $217, SPY basically might have saw that at the bottom in 2020 after the COVID crash, but unfortunately I can't show you options chains when SPY is at 217 because currently it's at 434. So we're going to make some assumptions here. And obviously the dollar amounts for ETFs and stocks are arbitrary anyways. So let's assume that we bought 100 shares of State Street's SPY when it was at $868. And it's already fallen 50% to the current dollar amount of 434. So let's pretend that, let's say 6 months ago, I put $86,800 into 100 shares of SPY. The entire market just collapsed 50%, and my shares are now worth $43,400, or I've assumed a loss of $43,400. You guys follow me so far? So what I'm going to do is I'm going to convert this equity into LEAPS contracts. Here is the current option chain for State Street's SPY for contracts expiring December 20th, 2024. This is in 1,033 days. These are the contracts currently at the money. So let's go ahead and change the strike prices to show between 200 and 230. If you're wondering how deep in the money you need to go for a LEAPS contract, you basically can't go wrong just, basically cutting this in half. So let's assume half of 234 is the strike of 220. And these are the LEAPS contracts that we are going to be buying. The bidders are bidding $216 per share. The sellers are asking $221. Let's make the math easy here and say that we go with the bidder's price. So to purchase one LEAPS contract on SPY, this would cost me $21,600. So I'm getting this money to buy the LEAPS contract by selling my shares. After the market has gone down 50%, I'm going to sell for a loss, realize a capital gains loss of $43,000. And I'm actually going to buy two LEAPS contracts. Each one is $21,600, so I can buy two deep in the money call contracts for $43,200. So to recap the details of these contracts, the expiration date is in 1,033 days, almost 3 years. The strike price for the contracts is $220. The premium I paid was $216. My break even is the premium plus the strike price. So SPY, 3 years from now, only has to get above $436 a share, so I don't lose any money on these LEAPS contracts. And remember, this is after the S&P has just dropped 50%. So I'm gambling here that 3 years from now, after SPY has fallen 50%, that it can just get above 436 a share. So how is this possible? And to understand how option prices are determined, you need to know that the premium you're paying is made up of intrinsic value and extrinsic value. Extrinsic value is made up of implied volatility and time value. This is theta decay. So when we look at the contracts, the LEAPS contracts that we just bought, we need to think about how much of this is intrinsic value and how much of this is extrinsic value. To determine the intrinsic value of the contract, you take the current share price of SPY, 434 and 23 cents, subtract the strike price of the contract, 220, and 214.23 a share is how much intrinsic value you're paying today for these deep in the money call contracts. And to determine extrinsic value, you just take the premium subtracted from the intrinsic value. This means that we're literally only paying $177. This is how much we're losing to time value, theta decay, over 3 years. So LEAPS contracts are kind of strange this way. You basically are putting up all of this collateral to the seller today in order to control the price movement of these 100 shares per contract. And it's only costing you almost over 3 years, $177. So now we have to do a side-by-side comparison. Everyone's going to tell you that if the market drops by 50%, just buy and hold. If you can buy more, but definitely don't sell at a loss. In this video, I'm actually telling you to do the opposite. So let's compare someone who just holds after the market drops 50% versus somebody who converts that equity into LEAPS contracts. So holding the shares that have fallen to 434, it's worth $43,423. This isn't the premium, this is the equity for just holding on to your 100 shares that have dropped 50%. However, if you go with the LEAPS contracts, you're buying one contract with a premium price of $21,600. There is no break-even price for holding the 100 shares, but the break-even price for your LEAPS contracts, as we said, is only $436. So the intrinsic value of just holding 100 shares is how much the shares are worth. The delta is basically 1. But for the LEAPS contract, the intrinsic value is $21,423. Extrinsic value, pay to play, $177. It's basically a speeding ticket for 3 years. Whereas just holding the 100 shares doesn't cost you anything. You know, your shares move when the share price moves. There is no contract at work here. However, if you own the LEAPS contract, that's just as good as holding 100 shares. That is the definition of a call contract. You are controlling 100 shares without having to own the contract outright. As long as the contract expires in the money by expiration date, intrinsic value is converted into the real dollar difference between the strike and the current share price. So if you just hold on to your 100 shares, this costs you over 3 years, tying up the equity $43,423. But with a LEAPS contract, I'm only tying up $21,600, and I get that dollar for dollar share price appreciation should SPY go back up to basically where it was prior to the 50% drop. So the question is, if the market falls by 50%, do you want to double down? Do you want to double down and give yourself a time period of 3 years for the market to recover? Maybe it doesn't get back to all-time highs, but by leveraging your money, you can recoup your losses that much faster. And it's actually better because you can buy 2 of these contracts. And if you remember, we sold our 100 shares for $43,400, and we bought 2 LEAPS contracts for $43,200. So one contract gives you basically a 2x return controlling the share price movement of 100 shares of SPY, and two leaps contracts in effect gives you a 4x return over these 3 years. So let's say the 1,033 days go by and we're on the last day before these contracts expire deep in the money, and SPY has recovered to where it was before it dropped. It gets back to 868. Let's do a comparison between the buy and hold investor and the investor who converted their equity into leaps contracts. So if you just held 3 years for the market to recover, then you didn't make any money. You're back to basically break even. Your shares have appreciated back to 86,800. Yes, you might have earned some dividends, but let's just ignore that for now. And if you bought the leaps contracts, then the premium has appreciated to 64,800. Extrinsic value, implied volatility, and time remaining goes to 0 on the last day of the contract. So intrinsic value is just the difference between the share price of SPY, 868, and the strike of the contract, 220. So these two leaps contracts are worth $129,600. So if you were a buy and hold investor, you waited 3 years for the market to recover from a 50% drop, you got back to your shares being worth 86,800. But if you liquidated your shares at a 50% loss, converted it to leaps contracts, when the market recovered, your account balance would now be $129,600. So let's recap everything that we did in this video in order. And originally, we bought 100 shares of the S&P 500 index fund at 52-week highs. We perfectly mistimed the market when the market was most overvalued, overinflated, due for a correction. The market then corrected and dropped 50%. We perfectly mistimed buying into this market. So what are we going to do? We don't care. We're going to sell our 100 shares for a 50% loss and free up that $43,400 in equity. We're then going to use that money to buy 2 leaps contracts, and each contract gives us a 2x leverage on our money, basically, for controlling 100 shares of SPY. We're then going to wait 3 years or however long it takes for the market to recover, get back to its 52-week high. We're then going to sell the contracts for a profit. How much would we make? And we'd make about 86,800 above our cost basis of 43,400. So you can either basically hold your 100 shares, get back to break even, or you can leverage your money with the most conservative form of buying call contracts and 2x your money in 3 years. Sounds pretty good. So if you've made it this far in the video, at this point you might be saying, Jake, this is too good to be true. There has to be other forms of risk associated with buying leaps. And this is what I can tell you. The first one is you're not collecting dividends. As the person buying a call contract, it's the seller, the person still in control of the 100 shares, who's collecting those dividends over those 3 years. Second, leveraging leads to more loss in the negative direction. So even though the market has dropped 50%, it could potentially keep going lower. So it's nice getting those 2x returns when the market is going up, but if the share of SPY goes down, your leaps also lose money faster. And then finally, the worst case scenario is if at expiration the share price of SPY is below 220 in our example, that would be a 75% drop from the market. But if you just own the shares, you can give it more time to recover potentially. But if you bought a leaps contract, if at expiration the contract is out of the money, you lose 100% of the money you put up for the contract. That is the ultimate risk there. And last, you're just not in control of the stock. The person who is in control of those 100 shares has the most options, literally the most flexibility. If you buy a Leaps, all you can do if you want is sell to close it should you need to free up capital, for maybe like a life emergency. So there you have it, guys. That is my strategy. Currently in my Fidelity account, I have 200 shares of SPY. I'm about to buy another 100 shares. Should the entire stock market crash by 50%, you better believe it. That's what I'm going to do. I'm going to liquidate my shares at a loss and then double everything down by buying deep in the money call contracts until the market recovers or my account recovers. So there you have it, guys. That is the best strategy I can come up with for increasing your returns or getting rich after there's a significant stock market crash. If you guys enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.